Capital Record, where we defend free enterprise and capital markets because we believe in the dignity of the human person. Hello and welcome to another episode of David Bahnsen's Capital Record, brought to you by National Review. Very pleased to welcome those of you joining from our brand new YouTube channel. Would really love it for those of you watching on the YouTube if you'd hit like, if you'd subscribe, if you'd share it. We want to build up that subscriber base, and in the early stages of a YouTube channel, nothing helps drive the algorithmic momentum more than early activity, likes and subscribes and shares and all that kind of stuff. Appreciate your help and support as we build this out. And now let's get to the bottom line for today. I want to share with listeners of Capital Record a very important thing about capital markets, which is the bond market. I want to share why one can be, as I am, a fiscal conservative and fiscal hawk who is aggressively concerned about the fiscal health of the United States and the need to fiscally reform the way we spend money to manage our fiscal obligations, that is the debt profile of the country, and at the same time want to push back against the utter hysteria and nonsense that is circulated in recent days and weeks from fellow fiscal hawks, fellow fiscal conservatives, like-minded fiscal, shall we say, aligned brethren in the cause of fiscal sanity, who are, I believe, making the problem a lot worse with incorrect, albeit well-meaning, information about the bond market. And I do not bring this up today because it is a tangential, side-pocketed issue where some folks are right about the concern of the national debt, but wrong about the bond market, and I just wish they wouldn't share bad information. It's that the information they're sharing is going to make things worse because of this dynamic I have seen for my entire adult life that goes back even before I was an adult, into the infamous decade of the 1970s when I was just a wee little lad. And that is the boy who cried wolf factor, that we desensitize people to things they should be concerned about. We numb them when we do it wrongly. And this is what's happening with the bond market. Right now, the basic sequence goes like this. The United States has an unsustainable fiscal picture that is problematic for the future. That's a premise, and it's one I will simply say check. Premise 2, the new big, bold, beautiful bill did not address it in the way that many of us hoped, and in fact makes certain part worse. Check. I agree with premise number 2. Then you get to premise 3, which is, and the bond market is revolting. The bond market is saying, oh my God, this is horrible. I do not check premise 3. And then conclusion, therefore, we need to do something about our fiscal situation. So now let's recreate this with the first 2 premises in the conclusion and tell me who doesn't follow along. I do believe the fiscal situation's a mess. I do believe the new bill is not what we want it to be. And I do believe we have to address it and do something. So premise 1, premise 2, conclusion, you got me. I'm with you. I'll sign up. I'll lead the charge. Front of the line. Let's go. You throw in premise 3, and now all of a sudden it goes like this. Well, wait a second. Yeah, we got to go do something with the bond market. Oh, the bond market is fine? You'd said 4.5% was signs that the bond vigilantes were out, but it's one of the most reasonable costs of borrowing money in the world? Is the bond market actually saying our debt is fine? Is the bond market saying we don't need to make changes? Why have yields stayed so low if it's such a mess? Are all these people saying it's a mess wrong? They can't have been right about the conclusion if they were wrong about premise 3. Over and over and over again, we have experienced some version of this with different premises conclusion, but the same problem. Certain right premises leading to a certain right conclusion with some element brought in that is a counterfactual that screws up the entire logic. My friends, the bond market might very well rebel. And the bond market might at some point for the United States refuse to roll over and allow our debt to be rolled over and lead to a moment at which there is an expedited crisis around our borrowing and fiscal situation. I don't predict it. I don't say it can't happen. I just simply say the obvious matter of fact that it hasn't even come close to happening. And in fact, at a period of time where the Fed was a very significant buyer of our debt, meaning, okay, one could say prima facie, the central bank has intervened. They've now added trillions of dollars to their balance sheet. In fact, at one point, they owned 20% of our total debt, nowhere near the over 50% Bank of Japan owns of their debt. And it's come lower now. But again, they moved from a really, really low portion, about 4 or 5% on their balance sheet, to a much higher portion. So one could say, well, the bond market's working, but it's only working as the Federal Reserve is intervening and manipulating it. But now we have gone for 3 straight years of the Fed not buying our debt and in fact being a net seller, where they have reduced their balance sheet holdings by $2 trillion, and bond yields are right where they were. In fact, after Ben Bernanke's egregious quantitative easing round 3 that lasted from 2013 to 2014 and was the kind of big bazooka of central bank borrowing back post-financial crisis, when that QE round ended, bond yields came way lower, not higher. But there were many who kept insisting, oh my gosh, the Fed is sustaining the bond market. When they go away, things are going to go to hell. Then the Fed did go away. Things didn't go to hell. So now I ask you, what do you think happens next time the Fed wants to go do QE? Can the people who insisted it was going to lead to disintegration of the bond market now say the Fed shouldn't do it? Well, see, here's the thing. The Fed shouldn't do it. But the argument the people made against it was so categorically wrong over and over again that they've lost credibility. This is the problem with the doomsdayers that are using wrong premises to get to a right conclusion. They lose credibility. And by the way, they lose credibility for a good reason. If all you're saying is something prophetic, I believe the bond market will collapse, then fine, you're either going to be right or wrong. Most predictions of collapse don't work out very well either. But my point, because people make prophetic collapse predictions because it's easier than the hard truth of the way in which bad news actually is incrementally priced in and factored in over time. That's a little bit more academic, certainly a lot more boring, and less sensationalistic. And so we just prefer to go straight to the gusto. Oh yeah, this is going to lead to some implosion. But the problem with constantly predicting implosion is that it doesn't happen and then the public gets desensitized. In this case, though, I'm not referring to people being wrong about a prediction because I don't know, maybe they're right about the prediction. They're not making a prediction, they're making a description, and they're making it stone cold wrong. Our bond yield's going from 4.41 to 4.5%. That's bond vigilantes? Dear Lord. The bond yield of 10-year borrowing for the United States since the Fed got off the zero bound and the long end of the curve went higher has been somewhere between 4 and 5% for over 2 years. And it's been, tiny bit below 4 and right up around 5. But we're sitting here right smack dab in the middle of where we've been for 2 years, a little bit lower, a little bit higher at different points in time, as median middle of the road as you can get. It is not only not an argument that the new bill is creating a problem. If I were for this new bill, which I'm not, I would try to use the bond market as an argument for my side. saying, hey, if this is so problematic, how come bond yields haven't moved that much? It's just so stupid and so unnecessary. The reality is the budget's unsustainable because it's unsustainable. And the bond market has different reasons for continuing to put up with it. Dollar reserve status, superior economic growth, better opportunities here than other places. The taxing authority of the United States is still robust, the military strength. There is all kinds of reasons that the dollar and the bond market might still hold in there. And yet at the same time, we could say it's generationally unsustainable. It's not the right thing to do for our kids and grandkids. It is impeding real economic growth. I can empirically prove this. I don't need to prophesy and I don't need to wrongly describe. I can rightly describe that we went from 3.1 real GDP growth to 2% real GDP growth. That we have compressed economic growth. That's a real descriptive argument covering over a decade since we've blown out our budget deficit to GDP and our total national debt to GDP. That's an absolute fact. So we don't need to add wrong descriptions of what's going on or the hyperbole of prophecy that is over and over again wrong. And the people making it don't have any clue what they're talking about. They're not in financial markets. They don't know the bond market. They know tweets and rhetoric. And so, I'm talking about reasonable conservatives that I get along with saying things that are so outside of their lane. It would be like me critiquing a famous poet. And the reason I use that as an analogy is because I don't know anything about poetry. Now, there's other things I don't know anything about either, but I want you to think I do. But poetry, I'm totally okay if by outing myself. You are allowed to know that I am not a, shall we say, expert in poetry. The people that are talking about the bond market publicly are doing so for good reason in that they want to sound the alarms about national debt or bring up the point that this new legislation is not what we want it to be. I am arguing not that they're not helping, but that they're hurting, which is a more severe case because you are, by definition, undermining the first couple premises and the conclusion with the wrong premise intervening. A 4.5% bond yield is what? In theory, it is a measurement of our expectations for nominal GDP growth for the next decade. And if I were to believe that we were going to have 1.5% inflation and 3% real GDP growth, I would take that all day long. I'd take that inflation and I would take that real GDP growth all day long, and a 4.5 yield would be measuring it. It's not measuring fiscal collapse. What world do we want to live in where we want a 10-year in the threes? You want nominal GDP growth of 3%? That is not the world we want. Now, if you had a 5% 10-year, 6% 10-year, 6.5% 10-year, with only 1 or 2% real GDP growth expectation, but 4% inflation expectation, that would be a big problem. So I always say this at my own dividendcafe.com where I do my investment writing. The composition of nominal GDP expectations matters. But in theory, a 4.5 yield, unless you believe it's measuring 3.5 inflation and 1 real GDP growth, 4.5 isn't a bad bond yield. It certainly isn't irregular. First of all, if you're going outside of a short-term period of time, it's irregular only because it's so low. Look at a chart of the 10-year bond yield since the 60s. Now, I understand that we did get used to a zero bound at the short end of the curve, that the risk-free rate went down to zero from the Fed post-crisis and stayed there for most of the time and then went there again after COVID. And that anchored a lot of lower expectations for rates, which we see in what people want out of mortgages. We see what people expect in the bond market. But my point is, it is a very low yield historically. It is not pricing in vigilantism or a bond market rejection of U.S. debt. And even in a shorter term period where we got off the zero bound, it's just right smack dab in the middle. If it goes up to 4.7, 4.8, is that starting to point to something? If it comes back down a little, Does that mean, at 4.5 I was worried, at 4.4 I'm not? This is just hysteria, and it's idiocy. What we need to do is stick to what we do know, which is that real GDP growth has been compromised by excessive debt, and that mathematics tells us that debt growing at 6% a year with an economy growing at 2 to 3% a year when you already have 37 trillion on the credit card is unsustainable and a very bad idea. These are things we know that we can make the case for, and then add in the kickers, such as entitlement reform needed, the way in which various obligations of the federal government do not even get captured in that 37 trillion of debt. There's all kinds of bad news if you want to talk about bad news. But when you make a case that something is illustrating the bad news when it isn't, you undermine the case about the bad news. This matters because my objective for sound fiscal policy is to promote a free and virtuous society into the future whereby we optimize opportunity. When we misallocate resources with excessive government indebtedness, we do not optimize opportunity, and that's not fair to human beings. So I make a moral argument for controlling our fiscal irresponsibility, for reversing our fiscal irresponsibility. But on the same lines, I make a moral argument to not use the bond market as a premise in your sequence when it is doing no such thing. At some point in the future, if it does, then it makes sense. If you want to go out on record and prophesy it now, feel free. But borrow from history a little before you do that. Look at the fiscal insanity in Japan, in the United Kingdom, in the European Union, and yes, in the United States of America for the last 30 years. And then look at its bond market for the last 30 years. And then, putting the two together, maybe understand why sometimes nobody listens to us. Thank you for listening to David Bonson's Capital Record. Please forward, share, save, all the things. Thumbs up, likes, and look, if you don't like it, you can do that too, but I hope you do. Really enjoy having you be a part of this Capital Record. Take care.